I gotta admit, y'all, prior to January of 2025, I had no idea this guy and his company existed. But he has access to a program that is offering up to $13,000 for FHA borrowers. These are men and women that are either building a new home or they're buying an existing home. And there's 13 grand available to be used for things like down payment and closing costs. And most banks don't even know it exists, or if they know it exists, they're choosing not to participate. Once I found out about my guest and his company, I knew for sure we got to put him on TLOP. If you're a home buyer, a home builder, a realtor, or a mortgage professional, you got to tune in to figure out who's this guest, what's his company, what's their product, and why are you not participating? Ladies and gentlemen, boys and girls, children 18 plus, you are tuned in to the Loan Officer Podcast with me, Dustin Owen, and a very special guest. We are live and on location, Mastermind Summit 2025 in Las Vegas at the Bellagio.
That's right.
He is originally from Tejas. He is an Air Force veteran. He is an 18-year mortgage industry professional.
That's right.
He is with Attainable Housing Authority
Advocates.
God dog it. He is my friend, the one, the only, Mike Preito. Mike,
Man,
welcome to TLOP.
So happy to be here, Dustin.
Dude,
Thank you.
I knew I was going to screw that up. Like, Attainable Housing Advocates.
That's
AHA.
Right. That's right.
It's like AHA DO.
There you go.
Yeah,
AHA
and I
DO.
screwed it up, but we're going to talk about HOPR,
That's
and we're
right.
going to talk about AHA.
That's right.
But before we get to HOPR, before we get to AHA, because, dude, I promoted that as hard as I could to be like, if you're not tuning in, you're missing out.
You're missing out.
So I don't want the people to miss out.
That's right.
You don't want the people to miss out.
Do not.
You and I met in January at MortgageCon.
That's right. MortgageCon. Orlando. Beautiful Orlando.
Yeah, beautiful in January. No one calls Orlando, Florida, my hometown, beautiful June, July, or August. If you do, you're a psychopath.
Okay.
Because it's miserably hot and humid.
Oof.
I got up this morning at 5 a.m. to catch the flight to Vegas. 5 a.m. I walk out to the garage and suffocated on the air because it was so thick. Like, you're in, what, Phoenix now?
Yeah.
Phoenix is hot.
Yeah, it's very hot.
But it's
dry.
not humid.
That's right.
But it's not humid. Yeah, Florida, June, July, August, even September, gross. That's why I'm looking to move to Frisco, Colorado next year during
Let's
those
go.
summer months. But let's let the people get to know Mike Preito.
Okay.
So you spent 18 years in the mortgage industry.
That's
Now,
right.
was that as an underwriter, as a processor? What did you do while you were like hardcore into the mortgage industry?
Yeah, hardcore, the majority of those years was in the origination space.
Okay, so you were a loan originator. Now,
right.
were you doing that in El Paso, where you're originally from, or were you doing that in Arizona, where you live now?
in Arizona, where I live now.
Okay.
So we did it in Arizona. I did a lot in the affordable lending arena.
When you say affordable lending, like, were you doing like Section 8 housing affordable, or were you doing like down payment assistance, or
More like-
was it like CRA lending?
Yeah, good question. It was more like affordable lending to really manufactured home buyers. That's where I
wow.
got my career started. So,
Okay.
Yep, did a lot of construction to perm financing in the manufactured home arena. And then-
Double wide and single wides?
That's right.
But they owned the land, or
That's
could
right.
they rent the land?
It was all FHA business.
Okay, so
owned
they had to own the land.
That's
Okay.
right. Yep.
So that's how you got your start.
That's how I got my start.
Were you working for like a broker or a lender, or were you actually working for a like a developer of the manufactured homes?
I was a direct lender.
Okay.
And we partnered with many of the manufactured home retailers across the country, and that's how we got our that was our referral source.
So like you all were like making the richest in the niches.
That's right.
As early as what, 2010, 2012?
I started my mortgage career in 2007.
Okay.
Right before the crash, really.
Wow.
Yeah.
Okay, so
So-
you survived the crash,
Survived the
worked all the
crash.
way through it, but then you eventually got recruited away from originating.
Yeah, that's right. So,
Okay, so-
I moved up, went into processing, underwriting, and then eventually left the affordable arena, joined a bank where I focused on CRA efforts. So my heart has really always been in that affordable arena, helping first-time home buyers, really, but quite frankly, even second and third-time buyers that need assistance, right? And so that's where I landed.
Yeah, correct. That's like the biggest misconception about FHA for anyone getting into the industry, or even like talking to a younger, newer realtor. Like, oh, FHA is for first-time home buyers. I'm like, no. I go, it may be the drug of choice and the best product for a lot of first-time home buyers,
Yeah.
but we have plenty of people who this is their third FHA loan, or they used a conventional loan to buy a home 10 years ago, but for whatever reason, today FHA is the best product for them.
That's right.
And the program that you have access to through your company, which is called your company's AHA.
That's right.
Right, but the program is HOPR, is a program that partners with HUD, it partners with FHA, and allows you all to offer 13 grand.
That's right.
For people who are eligible or qualify, and they can use that money for down payment.
That's right.
And closing costs.
And much more.
And much more.
Yeah.
So what I want to do is we're going to introduce this.
Okay.
Put it on the worldwide stage, or at least, look, we're going to get at least 1,200 views on YouTube.
I love it.
We'll get another 3,000 listens on Spotify and Apple, plus probably 1,100 on LinkedIn, right?
That's
so
right.
we're at least going to get this out to about 4,000, 5,000, or 6,000 people over the next 7 days, and then obviously it'll have some shelf life.
That's right.
And then if people like it, they can obviously inquire. If they like it, they can share it, etc.
That's right.
But by the way, if you're not watching us on YouTube, you can't see this. Okay, Mike brought me a gift. Mike, I'm wearing this obnoxiously large hat that I do know is trendy and cool, but it's branded with your logo.
That's right.
Dude, from the bottom of my heart, thank you so much. I hope they can ship this back to Orlando because there's no way it's going to fit in my suitcase. And I don't know if I'm going to wear it on 2 more plane rides. However, 100% I'm rocking it on today's episode. So if you're listening to us on Spotify, thank you. If you're listening to us on Apple, thank you. But just slide over to YouTube, subscribe to our channel, because I have a ton of additional content on the YouTube channel.
Yep.
Like Spotify and Apple is just a podcast. YouTube, I have actual coaching videos and training videos that are free, and all you have to do is subscribe to the channel, but you could actually see me wearing this super large, obnoxious, what do they call that, fat hat?
I think it's a noggin boss is what they called it.
Yes,
So.
it's a large ass hat that I have on my head as you and I record from the trade show floor at Mastermind Summit.
Mastermind Summit.
So the audience knows a little bit about you, right? We know you're a dad. We know you live in Phoenix. We know you spent 18 years originating, which we love to hear because most of us that tune in are originators, or we run production teams. You've really made a name for yourself in the affordable space, whether it was in manufactured or in CRA lending.
That's right.
But you now are with this company, AHA.
That's right.
Do y'all call each other AHA, or do you call yourself Attainable?
It's AHA.
It is AHA.
Yeah.
Beautiful, because that's way easier for my dumb ass to remember.
Way easier.
And it's on your shirt, so I can just keep on looking over at you. I'm like, oh, it's AHA. AHA. What does the A stand for? Attainable. What's the other one? Housing?
Advocates.
Dang it, and Advocates. Attainable Housing Advocates. AHA.
Right.
Tell us about AHA, because I think once we know about AHA, we'll understand HOPR better.
Yeah.
And then finally close this out with figuring out, how do I get access to this money? How do my home buyers get access to this money?
That's right.
But what's AHA for those of us that are new to you and new to your company?
Yeah, so Attainable Housing Advocates, we have a team of program advocates or home buyer advocates that administer the HOPR program. And when I say administer, what HOPR is a social innovation research project, and so they need a group, a certified group that can administer the program, which means we're collecting the data, we are enrolling clients in pre-closing education, we're also providing post-closing financial mentorship. Really what we're addressing is what nobody is talking about, and that's this. Everybody is talking about, let's get buyers some assistance, some down payment assistance, let's get them a little pre-closing education. But those buyers are the ones that, quite frankly, are living paycheck to paycheck, and they're given this little bit of education, large lump sum of cash, they get into home ownership, but then you just kind of wipe your hands of them and they just potentially continue to live paycheck to paycheck. We are addressing that problem right there. We want to not only provide education up front, give them a little access to a little bit of cash to get into a home, but then we want to provide post-closing financial mentorship, which is really going to inspire, motivate, and encourage them to put money in their savings account, because the reason mortgages default is not because you lose your job in year 2 or you have an emergency situation in year 3. It's because when that hits, you have nothing to fall back on in savings, and that's the problem. As we've launched with all these national retail lenders across the country, all of the chief credit compliance officers, underwriting teams, they absolutely love what we're doing.
No way.
They absolutely.
Oh, I thought they would look at this and be like, oh, not another DPA.
Yeah, exactly. And when they say that, we're like, you're right. It is not another DPA because it's not a down payment assistance program.
Because you're taking a holistic approach. I mean,
That's
you're
right.
literally providing financial education up front.
That's right.
Now, in return, if I heard this right, in return, by the way, I couldn't wear my earphones today because I refuse to not wear the hat. So again, people are watching like, why is Dio not wearing his earphones? It's a little weird.
Yeah.
Right? It's a little weird, but
The headphones are, the hat's not.
the earphones, headphones. Where am I coming from? I'm calling these things earphones.
Earphones.
They are headphones. Holy cow. My friends at Bank of England are now going to make me a shirt that says earphones. I once flubbed, this is going down a rabbit hole real quick, but I once flubbed and I said earballs.
Okay.
Like I was thinking like eyeballs and ears, like you need to look and listen.
Yeah.
Next thing you know it, I go to the speaking engagement for this branch at Bank of England up in the Panhandle of Florida, and anyhow, they give me a T-shirt, and it literally says earballs.
Earballs.
You know what? Someone's gonna make me a T-shirt that says earphones instead of headphones. But I'm not wearing my headphones, but I can still hear you. And if I'm hearing you correctly, you're like, no, we are gonna mandate these people get education up front.
That's right.
We then demand they sign up to let us research them.
Mm-hmm.
The minute they sign up for that, we give them some money.
That's right.
But then after they buy the house, we give them opportunities to earn even more money.
That's right.
Because your research has shown that the reason why someone could potentially lose their home is because, and this is where I maybe need to have you circle back for me, the reason why they're going to potentially lose their home or why people would is it because they don't have reserve assets? Like, what's the extra money used for?
That's exactly right. It's the reserve assets that's missing in today's world, right? It's the living paycheck to paycheck. And sure, getting into a home is great, but if you're living paycheck to paycheck prior, you're likely going to live that same way after. And that's where it becomes problematic. Nobody's talking about that. And the loan officers that have adopted this program into their markets have just absolutely seen a bigger opportunity for them to capture more FHA clients because the program is obviously tied to FHA financing. Now, you mentioned earlier that it's HUD approved or FHA backed. It's not. FHA and HUD, they don't approve DPA program. They don't approve entities. What they do is they provide this 4,000 page handbook.
Yeah, okay.
And this program fits the handbook guidelines.
Is that why it's called the 4,000.1?
That's
Because it was
right.
4,000 pages?
It might be 4,000 pages. I lost track of what the page count is, but yeah, so it fits FHA's guidelines to a T, and that's where a lot of these lenders are obviously capturing.
Yeah, so
more
not
business.
HUD approved or FHA approved, but it's one in which, hey, lenders are not having buybacks.
That's right.
Right? When you're utilizing HOPR money to go towards funds to close, FTC, funds to close, then lenders are not having an issue with HUD being like, oh, we're not going to insure that. That's an ineligible source. HUD is like, nope, that's an eligible source. All right, so walk me through that, because I know we tease it with $13,000. Is it truly, here's 13 grand? Is it a grant? Is it a silent second? Like, how does the consumer gain access to up to $13,000?
Great question. So I do like to highlight, in presentations when I'm working with loan officers, I'm like, okay, if you're taking notes, I want you to understand.
Stop there.
Yeah.
If you're taking notes. How about this? I know you're not going to take notes. Next time you have a decent month, go purchase yourself one of those Plaud wristbands and just record every conversation that you're ever a part of and ask your AI assistant to give you the notes.
That's right.
Because most loan officers were like me.
Yep.
Like, we didn't attend college classes. We would just go and spend $99 and buy the notes.
That's right.
And then we would study the notes for the exam and hope we would get a C because C's get degrees.
That's
Unless
right.
you're my son or daughter, at which point C's are not acceptable, children.
Not acceptable, I agree.
But in the real world, yes, you kind of made me chuckle. Loan officers take notes. Okay, cool. If you're taking notes, this is where you want to take notes.
That's
okay.
right. That's
Conclude.
me. That's
keep,
me
keep
stomping
going for me,
my foot on the ground in the presentation, right? Like, listen up, y'all. So the program, it's not a grant. It is not a gift. It is not a second lien. It never has to be repaid back. There are no income restrictions. There are no credit score requirements.
What?
There are no DTI caps.
Pinch me.
Yes. Yeah, pinch you, right?
Pinch me.
So that usually gets loan officers' attention, right?
Okay.
And so the buyer is choosing to enroll into a social innovation research project called HOPR. And what HOPR is going to do, just like any other research project out there, they're going to compensate that participant for their participation in the program. The participation involves the buyer doing about 6 hours of online education.
Okay.
That 6 hours of online education will allow the buyer Or, get this, Dio, a current homeowner who's doing an FHA refinance can also get access to this money.
Wow.
So, now, that person...
Which, by the way, that's a big deal on FHA Streamlines,
Yes.
right? That's the... Okay.
Yeah. So we'll touch on streamlines in a second, but yeah, so the owner or the buyer does 6 hours of education, and they earn 3.5% of their home's purchase price, up to $13,000.
All up front.
All up front.
Because I thought there was money, the way you explained it to me when you and I first met.
Yeah.
Because look, I'll be honest. Mike comes up to me and he starts with a compliment, which I love. Hey, bro, love your show. Okay, you ever want to get someone like me, shallow people, whose love language is like, affirmation? Yes, tell me you tune into my show, tell me you love it, right?
That's right.
But then he's like, and I want to come on your show. Like, you saw it today. I'm like, yeah, but I don't have time. Or, like, I don't know if people understand, we don't just have guests on.
Yeah.
And anymore, thank God, like we're pretty popular. And I still think we're the best kept secret, so please continue to share us. But you came up to me and you're like, hey, love the show. I was like, hey, thank you so much. I appreciate that. You want a picture? You're like, no, that's weird. I was like, oh, okay. I'm joking. But you're like, I would love to come on your show and talk about this program. I'm like, yeah, you and like 50 other people. Mm-hmm. But then as you started explaining to me, I was like, holy shit, I need to have you on the show.
Yeah.
So that's why we're here. But I remember when we met in January, I thought you said there was money that was earned through tax credits after the fact.
Yeah.
Is that in lieu of that's on top of?
That's on top of.
Holy shit.
Yes.
Okay.
You're talking $13,000 up front.
Okay.
$12,000 on average on the back
so
end.
Maximum
in tax credits.
So it's going to be the lesser of 3.5% or $13,000.
That's right.
Cool. So a $200,000 purchase price at $7,000.
That's right.
On a $400,000 purchase price, it's $13,000.
You got it.
Okay, so the lesser of 3.5% or 30. You can tell I was once a loan officer,
You
right?
were. I can tell.
Very cool.
Yeah.
I still play one on TV, by the way.
So because you earn that money up front, it's earnings. It's not a DPA. It's not a grant, which means they can use it for whatever they want. We've got loan officers that are absolutely crushing it with the program, where they're using the money to buy the rate down. They're using the money to pay off debt for the buyer at closing. Yes, this
Mind
is
blown.
assets. Yep.
Mind blown.
Assets that the buyer has full access to. The money is wired to title and can pay off cars, can pay off credit cards, can cover the down payment. But what happens if they don't even need the money for all of that? Guess where that $13,000 goes? It goes from their savings club account, which is where it's secured prior to close, into their personal checking account immediately post-close, which means you could replenish a buyer's savings account immediately as they start their home ownership journey. Full access to that $13,000, moving expenses, whatever they need. Now, our mentorship is also going to encourage them and teach them, like, don't go blow that money on a vacation.
Yeah, we need 3 months reserve,
Yes.
maybe pay off some credit card debt.
That's right.
Yeah, start that IRA, whatever the case may be. Okay.
We want to drive savings. We want to stimulate savings. That's what the program is really about. So in the event that they use the $13,000 up front to get into the home, maybe it's for down payment, maybe it's for the rate buy down, then what's really cool about the program is they get the additional tax credits later. And that's what we're seeing as we've surveyed these participants, and we send them 2 surveys a year as part of the research agreement.
For how long do they have to do the surveys for?
The surveys are for 5 years. It's
What
a
if they don't
5-year
do
period.
one?
If they don't do it, it becomes a data point for us. So who's responding to the surveys, who's not.
But you're not going to ask for the money back?
That's correct.
Okay.
Yep.
And the tax credits, I'm so sorry. I'm like, you can tell y'all I am very amped up.
He's rocking.
Are the tax credits on their property taxes or tax credits on their federal income taxes?
Federal income tax.
Okay.
Yep.
We won't dive down that rabbit hole. That's where it's like, look, if y'all really want to know, you got to reach out to Mike.
That's
like,
right.
Reach out to Mike and his team if you really want to know. But right now, I'm waiting for either you to pull the rug from underneath me and be like, oh, but here's a catch. I'm waiting for your catch. Or at this standpoint, I'm waiting for you to be like that 2 a.m. infomercial. But wait, there's more.
Yeah.
The but wait, there's more has to be the tax credits. Like, let's call that the but wait, there's more.
Yeah.
I do want to ask, is there a catch or what's the catch?
Yeah. So I don't like to necessarily call it a catch, but there is a real problem.
I don't like to call my wife mean, but sometimes she is.
Yeah, that's right.
Okay.
So there is a real problem with affordability and things going up, right? We're talking about, we're here at the Mastermind Summit, and we're talking, I hear inflation and things going up, right? One of the things that as a new homeowner, you have to pay is utilities. You have to have an electricity bill, right? You know you're going into that. You're going to have that monthly expense. So what we put together with this HOPR program is a mechanism that will drive their utilities down and give them access to that additional tax credit. So as part of the research project, instead of them moving into a home and then 6 months later they get somebody at their door knocking at their door saying, hey, I'd like to sell you a solar system for $50,000, $60,000, $70,000, finance it separately from your mortgage, put a second lien on your home, give you ugly financing, and give you a solar payment. Instead of that, they actually get essentially a reduced cost solar system that's financed by the loan officer into their FHA first lien mortgage.
Okay.
So they go into this owning their solar system free and clear from day one.
So my words, not Mike's. The catch is with this $13,000.
Yep.
We're going to send you 2 surveys a year. We're going to ask you honor system, shake hands, look each other in the eye. You're going to fill them out.
That's right.
The catch is, hey, you're also going to get a solar system.
That's right.
That solar system is financed essentially probably through the interest rate would be my guess, or somehow it's being financed. The participating lender has to, on their own way, whether it's a hedging strategy, a pricing strategy, a reduced comp strategy, whatever the case may be, they then have to purchase on behalf of their client the solar system through you all. But you all are excited because you think that solar system is going to lower their utility bills.
That's right.
Which then is going to help them manage any type of potential inflation.
That's right.
Okay.
Because
fair enough.
Yep. Now, the only thing different in what you said is that
I like how you said it so politely. Hey, here's where you were wrong, Dio. Hey, you kind of fucked up a little bit. Can I just reel you in and
let's reel Dio in.
Yeah.
Because there's no hedging, there's no comp hits. Loan officers love this program because the cost of the solar system is added on to the base loan amount, just like upfront MIP.
No.
FHA totally allows this with this little 4-page policy called the Solar and Wind Technology Policy. Now, I don't normally say...
Wait a minute. So I can, just like I can finance in my UFMIP,
yes,
I can finance in the cost of this.
That's right.
Up to a certain dollar amount, up to a certain...
Oh, I'm about to blow
You're
that
blow my
big
mind?
hat off your head.
Oh, wow.
120% LTV.
What?
120% LTV. Yes. So you're talking, let's say in Arizona, you've got a $500,000 house. 20% of that is $100 grand. You could go to a $600,000 loan amount in this scenario. That's right.
So I'm sold, right? I'm sold. I'm all in.
Yeah.
Right. And by the way, I have already put Craig Montgomery in contact with you, right?
That's right.
My day job is not TLOP. My day job is SVP of growth at Lower, where I help Lower run multiple branches, and I do a lot of other things on a national level, currently building out a CRM for them, with them, not for them, but with them. So funny, Rob Chrisman, I was doing something with Rob last week or 2 weeks ago, and he totally called me out on the words I used, where I was like, oh yeah, they're doing this and they're doing that. He's like, don't you work at the company? I go, yeah, but I'm not on that project.
That's right.
He's like, but shouldn't it be we? I was like, never thought of it that way. I just think, well, I'm not a part of the project. I wouldn't want to take any type of credit. He's like, it's still your company. And I was like, oh, well, then I wonder if it's me. I just said, oh, well, I'm building out this here. I'm not the only person. Yeah. I'm one of a team of 10. So we are building out the CRM. But yes, I've already put you in contact with Lower's head of production because I'm sold. I'm ready to roll this out to my branches, ready to roll it out to my loan officers. Yeah. Is there anything we didn't cover that you're like, wait a minute, I need to make sure that the people understand X, Y, or Z? Yeah. Because my next iteration is making sure I pimp you out and they know how to get a hold of you. But before we find a way to put a bow on today's episode, did we miss anything?
No, I don't think we missed anything. We talk about the we. I want to say thank you because we helped successfully launch the program with Lower literally within the last 30 days.
That's incredible.
And so I am stoked to be working here in the, almost immediately with Lower loan officers across the country. And, so hats off to you.
Yes, well, hat's on right now, but this hat will be coming off.
That's right.
It's heavy. Yeah. You know what we didn't do? We didn't go down this rabbit hole, but are you a wake surfer or wake skater?
Oh, wake surfing is
surfing.
A thing I'm all of a sudden really starting to like a lot.
Do you have one of those like $120,000 boats?
I have no boat.
Okay. You have friends with boats?
Yes.
Okay, that's all.
Yep.
That's actually the best boat.
Yep.
Is your friend's boat.
Your friend's boat.
Yeah.
Yep.
Well, that was probably the only thing that I think we were going to talk about that I thought was cool about you. That we didn't get a chance to talk about.
There's a lot more cool stuff about
But
me.
is there anything regarding, does HOPR stand for anything?
Yeah, of course.
Of course. If AHA stands for something.
We come from the mortgage arena, right?
Yes.
So we have to give loan officers more acronyms. So it stands for home ownership, promotion, education, and research.
Oh.
Yeah.
Nice.
So the R is very real. It is a research project. And it is amazing to see how many families are being impacted.
Now, you all, unlike me, you probably started with, well, we want to call it HOPR. How can we make HOPR stand for something?
That's right.
We call ourselves TLOP, right?
Yeah.
It's on my shirt. It's on your earphones, AKA headphones.
Headphones.
And people are like, what's TLOP? I'm like, you know what? What's Rolex? Because Rolex isn't anything. So TLOP's a brand, but what's Verbo? Or is it VRBO?
VRBO. Oh,
well,
yeah.
some people call it Verbo. TLOP, guys, it stands for The Loan Officer Podcast.
That's right.
But when you start launching coaching companies and career advisory services, and you start launching sister companies that are going to be very consumer facing, The Loan Officer Podcast doesn't play as well. And it was our fans that started calling us TLOP like 3-4 years ago, and we embraced it. So if anyone's ever wondering, like, what's TLOP, y'all, it's a brand, but it stood for or still stands for The Loan Officer Podcast. It's always funny. People are like, yeah, you know, the TLOP podcast.
Yeah.
I'm like, well, technically it's the Loan Officer Podcast or it's TLOP. Because if you say TLOP podcast, it's like saying the Loan Officer Podcast.
That's right.
Yeah, but HOPR stands for what again?
Home ownership, promotion, education, and research.
And AHA stands for?
Attainable Housing Advocates.
And you're Mike Preito, but if people want to get a hold of you, how do they do so?
Call me directly anytime, 602-400-6433. Happy to talk to you.
Are you on LinkedIn, or are you on Instagram, or literally call you?
Call me. I'm also on LinkedIn. That's where we heavily promote all of our loan officer partnerships across the country, success stories. Take a look. It's happening in your market. The program's available in 45 states. So
what states are you not available in?
Currently, the Dakotas.
Okay.
And then West Virginia.
Okay.
Vermont.
Okay.
And then Hawaii and Alaska.
Interesting.
Yeah.
Are either one of those states on the horizon, or is there too many hoops to jump through right now?
No, not a lot of hoops to jump through.
Okay.
They all are on the horizon. We want to be in all 50.
If you need me to go to Alaska or Hawaii to advocate on your behalf, look, I need a flight.
Let's go.
And I need a hotel.
Easy peasy.
And then I would love to go back to Hawaii. I would love to visit Alaska. Well, y'all, look him up on LinkedIn. It's Michael, a.k.a. Mike Preito.
That's right.
He is with AHA. His program is HOPR. He gave you his cell phone number. Reach out to him. Call. Get with your branch managers and get with your VPs of sales. If you're not offering this product, I really think it's something you all should be looking into.
Absolutely.
Cool. He's Mike. I'm Dio. You've just tuned into the Loan Officer Podcast. Unfortunately, that's all the time we have for you today, but we do look forward to catching you on the next episode. Peace.